Hello, everyone, and welcome back to Get Real with Jack and Cindy. I'm Cindy Morrison.
And I'm Jack Wallace. We're glad you're here. Thank you for being here. And we have a very, very special guest, Nikki Pauly.
Yes, with Home Team Lending.
Home Team Lending, which is our in-house for Chenoweth lender, but it's not just for people that are agents at Chenoweth & Cohen. Anyone can use you, and
Absolutely.
You'd be happy to help them. So
Absolutely.
Let's make sure and clear that up from the beginning. So there's a whole lot going on right now
It's a lot
in lending.
A lot.
You know, we got the settlement stuff going, and then we got the interest rates going, and the pricing and inventory, and putting it all together is just really fun and interesting. So we're going to, it's a good puzzle.
Yeah.
And, you know, this is where having some people that have had experience or have good resources can really, really make a difference. So
Exactly right.
we have a great resource in Nikki, and that is
Love
also,
Nikki.
we do. And it's an advantage to having an in-house lender for your real estate company is you do have someone you can call who will pick up the phone and will answer questions.
And I know this doesn't apply to those of you who are listening on Apple, wherever you get your podcast. But for those of you who are watching us on YouTube, I did not get the pink memo. So
We're baby shower day.
I literally,
is it a girl or is it a boy?
Pink and blue,
We're pink and blue.
I literally walked in and I was like, oh, everybody looks so bright and cheery. Okay, now we can continue on with the good stuff. I tried to get that out of the way.
Kind of looks like Easter eggs, don't we? Yeah.
Mm-hmm.
We're missing
Okay.
yellow,
It's kind of like when we interviewed Kristen and they put the pink light behind us. It was like so appropriate.
Yeah.
A pink aura behind us.
I would love a pink aura.
There you go.
Yes, you have a
one.
pink
You
aura.
definitely have one. All right, back on track to lending.
Yes, lending. We digress.
So, first of all, Nikki, why don't you just give us a quick overview of how long you've been in the business?
Well, I have been in lending for a little over 5 years and partnered up with Chenoweth & Cohen about 3 years ago.
Awesome.
So I've been in-house and full support for all the agents for a little over 3 years now.
And literally, she's down the hall from me. So I walk in there all the time. And I'm like, all right, Nikki, I need you to answer this question for me.
What do we have going on?
Exactly.
Yeah.
What I
That's
love
great.
about this too is that it's my background is in design. Your background is in design,
Mhm.
and it's interesting to me because there's a famous decorator, Charlotte Moss, that from years ago, and she was a Wall Street broker, and then became this huge interior designer. And there's a lot of those kind of crossovers between design and finance, which is so interesting that you would not put that together. But that is, I think it's the way our brains work in organization and patterns and all that. But I just find that interesting. Yeah.
Well,
yeah.
and I can even walk into homes and go, okay, I need to do this, and this to get this home sold.
Yeah.
And then I can tell you how to make that offer.
Yeah. I mean,
Yeah.
it's great. Like, I think it's sort of funny how we all find this business and what it is that we love about it. And I mean, I think
It works.
we love all components of it, because I do love the finance part of it. I think what's interesting right now is I always say this, and I think everybody should do this who's in our business, but watch the financial channels, whatever one you can watch as much as you can, or read the Wall Street Journal, whatever. But
I like to read USA Today. It
that
just
works.
kind of makes it a little more simplified.
Digestible.
Yeah.
Yeah, but it's like looking at the macroeconomic and how all of that affects everything is very interesting for us in the profession, so we can kind of watch the trends and know kind of what's happening, what's brewing, and what to expect. And with that being said, I think that we just got some really interesting data that came in from the Fed.
We did. So let me back up real quick. So all of our Chenoweth family, of course, will receive my Monday mortgage or update.
Which read
That
if you get it.
Do,
in your email.
because it is
It's really
a
good.
wealth of information. You can dive deep. You can see what's moving the market. You can share some of those graphs with your centers of influence and your clients and such. And so I really do try and educate everybody out there. So I'm happy to pass that along to anyone else that would like it. But yes, so my finger is on the pulse of the market every single morning. I get alerts 3 times a day on how mortgage-backed securities are trading on the market, which is where our interest rates come from. So the Feds did meet. They just had their Jackson Hole Symposium where, academics, the feds, they invite a host of people to sit down and go over future policy. And so Jerome Powell did speak last Friday that it is time for a rate cut. So
Yes.
they will be coming out. And let me just qualify this.
Yeah, that's
This is-
important
This
because
is
it's not.
It is not the mortgage rate.
Rate, yeah.
It is not a mortgage rate. When the feds
But it
speak,
affects it.
It absolutely affects it.
But my goodness, it helps.
Yes,
To
exactly.
quote Marilyn.
Right. So it is the overnight lending rate from bank to bank. So
Mhm.
these are the bank's Federal Reserve monies that are at the Federal Reserve. So this is going to affect directly your car payments, your credit cards, things of that nature. So those consumer loans, those are the interest rates that are affected by the Fed funds rate. Okay. Now, mortgage is directly influenced by mortgage-backed securities trading on the market. It follows the 10-year treasury very well. So we can put graphs together.
That's
and you
what
can
I always pay
see
attention to, the 10-year treasury.
The
That's
10-year treasury.
Yeah.
So mortgage and the markets don't wait for the feds to step in and quote unquote cut rates.
Mhm.
They start pricing that into the market already.
Mm.
So when Jerome Powell came out on Friday and said, yes, it's time, we will be cutting rates. So we know that there is going to be at minimum a 25 basis point cut at the September 18th meeting.
Okay.
Markets reacted. Mortgage rates started coming down.
Mhm.
Okay. The markets are pricing in a 73%.
So real
Go
quick,
ahead.
can I just ask a question? So does that mean the signaling of change is as important to the mortgage part as the actual cut is to
Absolutely.
the consumer loan?
Absolutely. So if someone is waiting till September 18th
Could
for
be
the
too
feds
late.
we're already getting that pricing.
Right.
Because they're maybe
That
looking into
pricing's already-
October.
The pricing is already here.
Mhm.
When Powell came out and made that announcement, markets reacted, rates came down.
Wow.
And I do want to say, people are like, I want to wait till the rates go down. Well, when a lot of people are saying that and the rates do go down even more, you're going to have more competition as a buyer because more people are going to jump back into the housing market.
Absolutely. Absolutely. And I did an analysis the other day for somebody that was saying, oh, I'm going to wait.
Mhm.
There is a cost of waiting. There is a large cost to waiting, especially here in our market where our homes appreciate 5% year over year.
Say that one more time.
Our homes in this Tulsa market appreciate at minimum 5% year over year.
So we're sort of at a natural appreciation. We're not like other markets where it bubbles up,
We do not
falls
bubble.
down, bubbles up, falls down. We have been very consistent. We did have sort of a normal, not normal. We had an abnormal increase a few years ago during the COVID years that popped us up. It kind
A little
of
bit.
brought us a little bit up to more national standards. So we don't feel like that's going to be a bubble for us. But the 5% is a good expectation of what you can
Always
put on your
expect.
house. Expect. Okay.
Well, and going back to a lot of people were like, well, we're going to wait till pre-COVID. We want to go back to pre-COVID pricing.
Mhm.
Pre-COVID pricing does not exist.
Yeah.
Right.
Everything has gone up. Building costs have gone up. Everything has gone up. We will never go back to pre-pandemic
And
pricing.
homes appreciate,
Homes
unlike the car
appreciate.
you drive off the lot that depreciates.
Of course, of course. So I had somebody say they wanted to wait. Where our interest rates were about 7.5%. So I said, let me just do a little analysis for you. Looking at a home purchase price of $350,000.
Now, what had they been? They went from what to that 7.5%?
We were in closer to 8.
Okay.
We have
A
gotten
0.5%.
real close to 8.
Mhm.
And then, your conventional loans are going to be priced out different than your government loans,
Mhm.
but there's some caveats to government loans. There's some additional funding fees and things of that nature. So while the rates may be a little bit lower, you're paying in other areas. So it's
Mhm.
always good to dissect that and be able to give that picture to your clients on what makes better financial sense for you.
Okay.
A government loan or a conventional loan.
Okay.
This was just straight conventional loan, 7.5% on a $350,000 home. Okay. Let's wait a year. Maybe rates will be down to 6%. So I ran analysis at 6%. However, that home appreciated. Remember,
Mhm.
so we're not buying that home at $350,000 now.
Mhm.
So I appreciated that home 5%, your taxes will increase, your
Mm.
insurance will increase. The cost savings between 350 at 7.5% and an increase in price 5% at 6% was a savings of $128 a month.
Wow.
And so
wow,
I will argue
that's amazing.
And we lost all of the equity for a year, so about $18,000 in equity for that property.
Mm.
If you're renting,
That's a very important part of that statement. So
Mhm.
180 a month. Is that what you said?
$128. I saved
128 times
$128.
12, so you're like 130, 1,500.
I'm
It's
so
like
glad he can do math in his
1,500.
head.
I don't do math in my head.
1,500-ish yearly, and then your trade-off is an 18,000 gain in equity.
Absolutely. And if you were renting,
So you're at a 16.5-ish deficit.
Wow.
average rent
Mm.
$2,000.
Mhm.
So you just spent $24,000 in that last year in
Yeah,
rent.
that's interesting.
Where
That's
you
where
could
your
have been-
equity would have gone.
That's
Yeah,
where you
yeah,
could have been
so
gaining
that's-
your equity.
That's the formula. That was the
Mhm.
trade-off. You are your own landlord
Absolutely.
when you do that.
You
Now,
are investing
and
in
then
yourself.
to Cindy's
Mhm.
point on that too, taking it one step further, is that's the assumption that if interest rates went to 6% and the market just stayed where it was,
Right.
but what we're really saying is if interest rates go down to 6, then that could bring that value way up. It could go beyond
Absolutely.
5% because suddenly there's more competition for that home than there was, and that's it's supply and demand,
It is
folks.
supply
It is
and
supply and demand. It's a very simple economic formula. So there's more demand and the supply isn't meeting it, which we still have people at 3% interest rate. So you're still not going to have a lot of people jumping in the market to give up their mortgage when you've got that.
Mhm.
Builders haven't been building as much inventory. So if that does happen, that year or two, we're going to have much more competition and prices could elevate. So it's not about, I think this is really important because I think we're all getting into this mindset of somehow there's this gouging of pricing and it's just supply and demand.
Absolutely.
It's really truly what will people have to pay in order to win the bid for these houses.
And a lot of times it might be over asking price.
Yeah.
So
Yeah.
not only have we increased our normal 5%, but if you've got 6 other people that you're going
So going back
against,
to towards like the COVID years,
Mhm.
whenever like we
call it the Hunger
could
Games.
get that part with it, but it's important because I mean I'm not trying to scare people, but it's something to be factoring because you could be getting into that where you have the bidding of houses like we did, except you don't have the benefit of those 3% mortgages anymore. So you got to balance those two equations, and that suddenly can I pay more, but yet I'm paying more in interest.
And you
So-
should marry the house, date the rate. Because
Yes.
remember, just because it's at, where is it today?
We're about 7s. You
Okay.
can get into some 6s. Absolutely.
So as the interest rates drop and it makes sense for you, then you can refinance.
Absolutely. And something that I've been coaching our agents on too is go in and ask for a seller concession.
Mhm.
Up front, offer full price for that home, ask for a seller concession to buy that rate down
Mhm.
so that you don't have to go through a refinance later.
Right.
Mhm.
Use the seller's money to buy your rate down to probably close to where we think rates are going to go next year.
Okay.
And then not have to incur the cost later to
Mhm.
refinance.
Which is also a good negotiating strategy in a way for the buyer because it's giving the seller the satisfaction of getting full price.
Mhm.
You know what I'm saying? Like I think I think now sellers are used to the idea that paying. I used to whenever I say they want you to pay closing costs, but they'll give you full price. Sometimes people say I'm not paying their closing costs, but tell them I'll take $3,000 less. I'm like that's the same thing.
It's the
Right.
exact
And
same
it's
thing.
like so I think now people are used to this concept that is a part of it. But I do think that sometimes people they like getting
the full
the
price.
price plus it's you're keeping your values up. I mean I think there's a lot that's a really good strategy. Now, so with all that being said, what's a good formula for people, and this may be kind of a longer discussion and you can say that if that is the case, but if you are indeed sitting on a 3% interest rate and you've been in the house for 5 years, let's say, or that would be about right now, right? So if you got something in 2020, so you're coming up to about a 5 year and maybe you're in that 3.1 zone. So you've been reducing because you've been building equity,
Right.
right? And So then to go trade off and then go into like a 7% and do a 1% buy down, then you're getting into like a 6, right?
Sure.
So is there some idea or formula on that?
I think everybody's financial situation is different.
Okay.
It depends on, is your family growing? If your family's growing, then of course
so
you
necessity is a
need
big part of it.
the bigger home. Are you downgrading? Do you need to downsize? So everybody's financial picture is going to be different, but I can do a full analysis for you, looking at your picture of where you are now and even the debt that you have versus selling, using the equity to put down towards that new purchase price. And perhaps you could even get lower than a 6 if we bring in a seller concession, and then also you bring in some money to the table to buy that rate down. You might be a lot better off than you think you are, just with using the equity in your home to bring that overall payment down as well.
So what I'm hearing you say then is the best idea for people would be, if you're starting to think about doing that, first of all, call your realtor to kind of get an idea of what your values are and expectations in the market. Second, get with you so that they can then have an analysis and see what a snapshot of their current situation looks like and what are the best options, because there are so many. It is not a cookie cutter formula anymore.
It is not. And these are, your biggest investments in life. It is always your best option to get together with your lender and do a financial analysis for you to see what all those options look like. Because if you don't live in this world, you don't know what you don't know.
Yeah.
So you're making decisions
and that's okay.
based on assumptions
you don't need to, right?
That you think that you can't afford a new home, but do you know?
Yeah.
Let somebody lay it all out for you, and then you can say, hey, maybe this really does work for me now.
Or how do you need to structure your taxes for the next 2 years? Or how do you get yourself in a place to where that will work?
Exactly. It's all about the education. Don't make assumptions on where you think you are. Let somebody take a look at it and educate you exactly where you are. Then you can make those decisions.
And your credit score affects what, I teach this class specifically about this, and it's amazing how many people go, but this was the interest rate. I don't know their credit score, but clearly their credit might not be the
stellar.
Best. Yes. So be prepared for that. And
which a lot of people are in that situation.
Absolutely.
For a lot of different reasons. And it's okay. Sometimes you just have to get really realistic and say, I got to work on that.
Yeah. I've got college debt for 2 kids, So they're looking at that income to debt ratio. I really do encourage people to get your free credit report every year. And you can download like Sesame. I'm trying to think of what, there's an app, but you can check your credit score daily, or you may have a banking app that lets you know kind of where you are.
And it'll give you a really good idea. Just know that that's your consumer score. It is not your mortgage score.
Right.
So a mortgage score, I equate it to the consumer score is kind of the tip of the iceberg. When I dive in and do that credit pull, I get the whole iceberg.
So the mortgage one is usually a little bit lower.
Well, it's far more in depth. They use a lot more data to produce those scores than what you're getting on the consumer side.
Right.
And of course, on the consumer side, when they watch it, they just got a credit card and their score dropped 35 points.
Or you paid off your car and now now it drops.
It drops.
Doesn't raise.
Right.
It
but
drops.
That's what you can see on your side. That's not the data that's going to be pulled.
Right.
Interesting. I did not know that.
On my side. And then back to rates, if somebody's bragging about they got, a 6% rate or a 5.75 rate, I can have 5 different families in my office at the exact same time, snapshot in time of where rates are, and everybody will have a different rate.
Right.
There are things within the loans called loan level price adjustments, and those adjustments are up and down based on your specific criteria.
So interesting.
Okay, so Cindy, you may be at 6. You may be at 6 3/8.
Why am I more?
And it's not because she's prettier.
Well, okay, we know what you think.
That's not the case.
That.
So I mean, and then you have to also say, somebody's bragging about a 6% rate.
Yeah.
What did it cost you?
Yeah.
Are you just paying for bragging rights?
Now, what does that mean exactly? Explain that.
In the sense of, yes, I got a 6% rate, but it costs me $8,000 to get it,
Right.
to buy it down.
Which can be a good strategy.
Yes.
Absolutely can be a good
Mhm.
strategy. But then you need to look at, what did it save you a month?
Mhm.
Did it save you $50
And how long
a
are you,
month?
and how long are you going to stay in the house?
How long are you going to stay in the house? And when are you going to pay yourself back?
I feel like that is not factored in enough, because all
You
the
have
buy
that
downs are
analysis.
important and it's a good tool, but you really have to think about, are you somebody like, I'm a nester.
I am
I'm
too.
my own worst client, because I stay in my houses forever. I like my house and I just stay there. So whenever I stay there, I know that those kind of buy downs for interest rates would be a good plan for me, because I'm going to reap the benefit for a long time and I'm going to gain back that money quickly and then be into a savings. But if you're a 2 or 3 year person,
Right.
which a lot of people are, it's kind of like new cars,
God
old
bless 'em.
cars, and all
Yeah.
that. If you're a 2 or 3 year person, which I have lots of them, and they do well in another way, because they get that tax advantage,
Mhm.
which I think I've missed the boat on. Because if you stay in your house for 2 years and then you go somewhere else, you get to keep the profit. And so that's a really good ladder of equity that you get no other investment. You
Right.
get that.
Mhm.
So I am not downplaying that, because I think that's huge. So it's like, but that would not be a situation where this buy down necessarily would be the best plan, because you'd be putting so much money up, you wouldn't recoup it before you're going to trade it out.
Yes, you want to do that analysis on what your rate would be without a buy down. We call that
Mhm.
par.
Mhm.
Or buying a rate down cost X and it saves you X. That's what you need to look at. What is
Right.
that monthly savings? So then you just divide that monthly savings into what it cost,
Mhm.
and it'll give you the months in which you pay yourself back, so to speak.
Right.
If it's 72 months before you pay yourself back,
May not be a good idea.
not the best idea for you.
Unless you're
Right.
somebody who's going to stay there literally until the day you die, and then it might be. I mean, but I think
Unless
that's
we're
rare.
using someone else's money.
Yeah.
If we're using the seller's money to buy down,
Then who cares?
then we love that.
Yeah.
But it's probably not the best financial decision if we're spending money out of your own pocket.
Mhm.
There's too much in life that can change.
Right.
Yeah.
Not to mention interest rates, but too much in your own life that can change in
Yeah.
6 years.
That's the only thing we're guaranteed, is that there's going to be change.
Mhm.
And
Absolutely.
I'm sorry to go into all that, because it's a little bit nitpicky, but there is, like I have lost a lot of money over the years by not doing the 2-year move up, because I think I could have, I think I could have made. For me, there's been a little bit of a hiccup, because I like to do too much to my houses,
Mhm.
so I don't really know that I would gain that
Overbuild.
much, and then the
Mhm.
cost of doing the transfer each time. But I do know that it's a really effective way. For people that can do that and move up. But I think that's the one thing I just don't hear people talking about enough, that the buy downs are great, but you got to make sure the buy down makes sense for how you are going to be in that house and
Absolutely.
what it's going to
And
do.
I also feel like the majority of the lenders out there right now are quoting their rates with a buy down, regardless if that's what's best
Oh.
for their client or not. They're not even looking at how long they're going to
because
stay
we're
in the home and
fixated
what
on interest
we're
rates.
so fixated
Yeah.
on interest rates. So everything that you see,
Especially since COVID. I mean,
Mhm.
it's just laser focus.
laser focus.
And
And
it's
so whatever
so-
that quote is, ask, is there a buy down on that?
Yeah.
Because I would say 90% of the lenders out there are quoting rates on a buy down. And I don't do that.
Right.
Yeah.
I quote where the average rate is right now, and then we'll have a discussion
Figure
on
that
where
out.
you are.
And when they
specifically.
quote that, then how are they're buying it down for for a while we did the arm, basically, where they would buy it down for 2 or 3 years,
the 2-1,
and then it would
or-
balloon the 2-1, which was effective in the beginning. I mean, it had its merits, but now we're looking more. People are buying down for the length of the loan.
Exactly.
Okay.
Exactly.
And let's talk about the different kinds of loans.
Sure.
Because as I talk with you, it's been interesting to learn what self-employed people, what kind of loans they can get
Sure.
versus in the past. So let's go through the general loans, and then let's drill down a little
Sure.
farther.
So your most common loan is your conventional loan.
Mhm.
It is backed by Fannie and Freddie. So each loan program is going to come with their own
Those are not
set
people.
of guidelines. They're little puppies running around.
Maybe you have a grandma Franny
yeah,
that does.
yeah.
But
So each loan is going to have their set of underwriting guidelines. And so that's what I dive into when I pull your financial data, see what your situation is. There are some programs out there that if you have deferred student loans, that they require a 1% payment to be used as qualification. Other loan programs require a 0.5%. And so as a lender and a loan officer, if you're not knowledgeable about that information and you just put somebody in a loan where it's a 1% hit, their debt to income ratio is going to be a lot higher than if you put them in a loan program that was 0.5%.
Interesting.
So even Fannie and Freddie, while they're conventional loans, have some different guidelines there.
Okay.
So it's very important that the lender is knowledgeable on those types of situations. So those are your conventional loans. I might add that there is a conforming loan limit for conventional loans. That loan limit changes every year. For this year, we are...
Explain in layman's terms what conforming
means. So you've heard the term, I'm going to get a loan or I'm getting a jumbo.
Right, okay.
Or jumbo, okay. So conforming loan limit, anything below jumbo, okay, is $766,550 for this year.
To be specific.
If you got a loan for $766,551,
you're conforming.
Your jumbo. You just went above
if you went above,
conforming loan limit.
Under that. Okay.
Yeah. So
and what does that mean if you've gone up to the jumbo?
Completely different underwriting guidelines.
Okay.
Completely different. That is when somebody really needs to shop lenders, because we are no longer in conforming limits. The guidelines.
Is that private money now?
Well, you're getting into some of your bigger investors, some of your bigger banks.
So kind of more private than governmental.
Absolutely.
Yeah.
Absolutely. And so each lender is going to have their own set, and each investor own set of risk levels that they're willing to take on with those different types of loans. So some may have a max loan to value of 80%. Others may have a max loan to value of 60%. So very important to shop those on that, because I've seen pre-approvals come through where the person was having to come out of pocket $40,000 on a luxury property. And I was like, wow, well, I can get you into that for 15% down, so I can save you a ton of money.
Yeah.
Maybe you want to put that much down. I need to look at your overall financial picture, but nonetheless, there's big differences when you get above that conforming.
Right.
Okay. So then after the conventional, everything else is going to be government. So now we got Jenny Mae coming into the picture. So Jenny Mae is your...
she just sounds on her.
She's Barbie's friend to get her.
She sounds
Fanny and
peppy.
Freddie and Jenny.
She was the Stuco president.
So then you've got FHA. So FHA is going to allow...
Which is what most of our loans are anymore, right?
Well, FHA does not hit you, so to speak, for a lower credit score. So anytime I have a client that has a credit score getting at or around 700 or below, I'm probably going to look into an FHA product for them, because FHA allows for a 580.
And isn't 700 a fairly average credit score?
It really is. Yeah. Absolutely.
I mean, I think that's the thing.
What is the average credit score? What?
A 700.
Oh, okay.
I think that's the one thing. I think people have been kind of like, because it's like the lower category because of FHA, there's kind of this feeling that it's subprime, and it is not. That's a very average credit score for people.
Absolutely. Absolutely. If I get somebody that I've got an 800 credit score, I'm like, oh, wow.
That would be my mom.
And
Jack.
I'm proud of it. I've worked hard for it.
Yes, I've worked very hard for mine as well.
It doesn't make any difference, because over a certain point, it
really doesn't.
Yeah, but I like it. Yeah.
So on conventional has a tier system for where is your credit score, and then your rate increases with each tier that you go down. So as that interest rate's ticking up because your credit score is going down the list, it is probably in my client's best interest to flip them over to FHA, who does not have that tier system in place. Okay.
So it's more forgiving, let's say.
Absolutely. The debt to income ratios that are allowed on an FHA loan are much higher.
And you bring less money to the table.
You can. So FHA
is required to bring less money.
3.5% down. There's a misconception out there.
20%.
20% that everybody has to have 20% to get into a home loan.
Not the case.
That is not the case.
It's not a bad idea to do if you have it.
But nonetheless, let your lender look at it and see where that money is best spent.
Right. I'm depression baby, evidently.
You can get into a first-time home buyer can get into a
Yeah.
conventional loan for 3%.
Yeah.
Who knew that?
Mhm.
And then typically 5% down is what people are putting down
I want
on a
to
conventional loan.
I want to interject one thing here that I think is really, you and I were discussing off camera beforehand, because I do have a problem with us pushing younger buyers or people who don't have reserves to get into houses and then not have. So that 3.5 or whatever percent to get into the FHA, and then you could put money aside is smart.
Yeah, absolutely.
I do think that's a very smart plan. Putting all your money into that house sounds good, but then you've locked up your money that you may need to do heat and air problems or those things. So having reserves is very important. So balancing those two of having money at the side and then how much do you have to put down, I do think that's a really important thing. So
I always say cash is king.
Yeah. So that 20% thing, you have to
weigh it.
You have to weigh
You
it.
have to
And when
see
money
what's
was
best for you.
cheap, it was kind of different, but money is not as cheap as it used to be. So I think it's really important to figure that formula out. So,
Absolutely.
sorry, off track. But
No, but that's great.
Yeah. So FHA is a government loan.
A lot of first-time home buyers do
A
FHA.
lot of first-time home buyers do it. With any government loan that you get, you are going to have what's called a funding fee, and that is the government's fee for using their program. So just know that. Again, we've got to weigh these different products
and
out
mortgage
and see
insurance.
what's best for you. Exactly. Mortgage insurance on FHA never goes away.
Mhm.
And on conventional, you can get out of mortgage insurance if you step into 20% down. Maybe that's where that theory is coming from. And once your loan value gets down to 78%, mortgage insurance will automatically drop off. You can request it to be removed at 80%, but it'll automatically drop off on a conventional loan at 78%. So you don't have that additional cost. A lot of times, if my clients get into an FHA loan, I do what's called a yearly mortgage checkup on them. And if I can see they're getting close to getting a 20% equity in that property, I will most likely recommend a refinance so that they can get out of that mortgage insurance.
Even so, like somebody, let's say, that definitely has 20% now, but I have an FHA, but then my interest rate is like 3.15. How do you know when it's competitive? Yeah.
Yeah. So I would
time for Jack to move
for you.
No. So maybe refinance, but not.
Yeah. So other government loans will include your veterans, your VA loan, which is 100% financing.
And goes up to $1 million. I didn't realize that until I had a listing that the person who bought it
and I've
had a VA
loan
loan just right under $1 million.
You can do it's all it all boils down to their entitlement, what the veteran's entitlement is, and
which varies greatly.
It can from one veteran to another, and those debt to income ratios. So there's a lot that plays into that. If they have no other debt besides their home purchase, then perhaps their debt to income will allow for $1 million purchase, while others would not.
We've also had a very important change, which anybody who's a veteran or represents veterans should know about, being allowed to pay down or have a seller. How is that again? So they can buy down.
Well, so what the VA stepped in and said was, with the NAR settlement, with respect to buyers paying their realtor's commission.
There you go.
Before, a veteran's loan really limits the veteran to what they are allowed to spend in costs on a loan.
Which was to protect them, that the seller would be funding them, not them funding them.
Exactly. So VA said, these are items that a buyer cannot pay for. And one was commission to their realtor. With the NAR settlement, VA has come out and updated their guidelines to state that, yes, they can now pay that, and it is as a closing cost.
Okay.
It is not rolled back into the loan. It is an added closing cost. So if you are paying your buyer's agent 3% of that purchase price, then that 3% is added as a closing cost to that veteran. So while we say 100% financing, there are always out-of-pocket costs.
Sure. And also, let's just make sure we stay for the record. That is not something that we as real estate agents have asked to happen. That is something that happened out of the government settlement, again, in the best interest of the consumer,
Allegedly.
But
Yeah.
so I just think that's really important because that was
For those of you who couldn't see the eye roll
Right,
while you're
right.
listening to the
Or
podcast.
the air quotes.
Yeah.
yeah. So I think that's just an important thing because I think they always make it sound like we're asking for something that it was something that was always incorporated in the structure of the way that the MLS was set up and compensation, which no longer is. So it's an allowance so that the veterans can be competitive in the same market.
Exactly.
It doesn't put them at a disadvantage for being a veteran like they would have. Yeah.
Well, and so I'm going to digress for a moment and just say that if agents are going on listing appointments and you've pulled the comps for this neighborhood and this property and everything's coming in around 600,000, okay, and your seller wants 600,000 for their property as well.
Mm-hmm.
However, they say that I am not paying a buyer's side commission.
Mm-hmm.
Well, then you're already 3% overpriced.
Right.
Because all the comps that have been
incorporated
pulled,
that.
the price of those homes included, most likely,
Well,
6%.
we can go back on records at the moment and see what
Absolutely.
what was offered out, and they had to live by
And they
that.
appraised
Yeah.
with those values being included in. So something to keep in mind.
So do you think then in that reality, I mean, this is interesting. This is completely off subject, but it's interesting. It just came to me. Should we be valuing those homes at a 3 or 2.5% lower?
Absolutely.
I mean,
I
boy,
told
do
my
sellers
sellers
not
that.
want to hear that. I mean, so you would say, okay, at current, no, if there was no payment of the fee, then this is what the value would be,
Right.
and then take it down. But if you put
I've
it
told
with
two sellers that,
interesting,
and both of them
That is
said,
really
"Never mind,
interesting.
I will go
Yeah.
ahead and
I mean, I've
pay
thought that, but I've
2.5
not
or
really
whatever."
gone to that level. But that definitely makes
It makes absolute sense.
because you
those
can't do
pers-
apples to apples. I mean, this whole thing has gotten so confusing. But I mean, if we're going to make the transition, well, not if we are
When.
making the
Yeah.
transition. So the apples to apples would be to reduce it by 2.5 or 2, like what the average 2.75, let's say, off of that commission. Or if it's a neighborhood where it always has gotten 3%, typically then 3. But yeah, that's interesting. Very interesting. Because I do think we're running into where there's being a lot of homes are being put on the market and we're having to make a price adjustment because the market is not supporting the price that the 6 months. So then you're even at more of a deficit by incorporating that and not accounting for that.
Exactly.
Okay.
Exactly.
Interesting. Yeah.
Other loans, USDA.
USDA.
Oh, back to the veteran loan. Also, you can only have one veteran loan at a time.
So a veteran
I didn't know
loan, so any of your government loans, they are for the purpose of your primary residence. You cannot have more than one primary residence. Okay. So in the sense of you cannot have multiple VA loans, FHA loans, because you cannot have multiple primary residences.
So you would have to do your vacation home on a conventional
On a
loan.
conventional loan.
Or if you're
because
going to keep your FHA home as a rental, which you would have to wait a certain amount of time in order to do that, right? Because I mean, you can't buy an FHA as a rental.
Right.
So, but you can buy a primary home, live in it for a number of years, and then eventually make it a rental and still keep the FHA loan.
You're not going to be able to have two FHA loans.
But you'd have to go to a conventional
You'd
to
have
buy
to
your
go
new
to a
home.
conventional. Correct.
And many condos won't let you do
FHA.
FHA.
Yes.
The condos
Correct.
are tricky.
Yeah.
Very tricky.
There's a lot of things. There are a lot of them you can, but it has to do with how many owner to renter and all those kind of.
It's a
protecting them,
condo review.
protecting the FHA underwriting, which makes sense, really. But yeah.
Well, when you have common walls and things of that nature, your risk level goes up on what your neighbor is doing on the other side, things of that nature. So.
All right, so USDA
USDA
for land.
USDA is for purchasing home.
Mm-hmm.
So it is for properties that are out in more rural areas. So there is actually a map, a USDA eligibility map, where you can plug in the address of that property and it will tell you immediately if it is RD, USDA eligible. Those are synonymous with one another.
I always think USDA meat. Like,
Yeah, I know.
Exactly.
There's like
I know.
farm,
So
cows.
I refer to it as RD,
Yeah.
rural development. So
Because she's just like that.
I am just like that. So then one, the property has to meet, that geographical selection
Okay.
first. Then your
Most
borrower,
importantly, yeah.
most importantly, then your borrower has to meet that criteria. And I will say that USDA has much lower debt to income ratio guidelines than any other government loan. So there's something that we refer to as a front end and a back end DTI.
So lower means you have
debt to income
to income ratio.
DTI.
So when it's lower, that means you can afford less home.
got it, because you have to have less debt in order to buy.
Correct. So an FHA loan, for example, we can get real close. We can kiss almost 57% debt to income ratio. Okay.
Oh.
Yeah.
I can get really, really close on it. RD, 41%.
Oh,
Wow.
Okay. The front end on RD, they also have an equation for that, which is your front end debt to income ratio is your house only. So the principal, interest, taxes, insurance on that property, that's going to be your front end DTI, 29%. So
if somebody's actually operating a farm though, and their operating costs for that,
if it is an income producing property,
it's a whole other level.
they're
Got
probably
it.
going ag.
Got it.
An
So we're talking
agricultural
more.
loan.
We're talking more hobby farms and.
Right. If it's not
Okay.
income producing, then yes, it can
Okay.
it can go RD.
So I think that's because it sounds like USDA would be more like your income producing farmers, but it's
Right.
not.
Not
It's really
necessarily.
more hobby farmers or rural living.
in 7 years, I've never had one.
Well, and they
I've
are
never had a buyer
very,
that has one.
very stringent on income. I mean, to the point of if you've got an 18-year-old kid who has a job, I have to report that income, even though that kid's not on the loan. I mean, it is very stringent on everyone living underneath that roof who is making income.
Interesting.
So a lot of times,
Why?
those are just their
Just
underwriting because it's 100% financing. And by God, if
okay.
you want that
Got it.
100% financing, I mean, it truly is for
There's going to be a
those
trade-off there.
I mean, you have to be
individuals
honest.
that-
We all make fun of our government at work, and there's reasons why, and we certainly haven't gotten it all right by any means. But it is interesting when you really look at the reasons why they put these barriers
Parameters in
up and
place.
these perimeters is to protect the value of the book that we as America are buying, because we
Land.
are the ones backing these loans. That's one of the great things about America is you have the opportunity to be a homeowner, but with that comes responsibility of meeting these stringent
these
requirements.
guidelines. And those programs.
So we don't
anytime
do
you have-
another 2008.
Those programs are really in place for your lower income families to help them gain wealth through home ownership.
Makes sense.
So it's giving them that
Yeah,
avenue for
makes
home
sense.
ownership, because that's
And it helps
That's
build
where
up
we
those
gain our wealth.
areas, and it
Mhm.
also helps to build up areas that are suffering a little bit more,
perhaps
rural areas. I mean, I think that's one of the reasons why those geographic areas is to help support those areas
Those
that people
outlying
can
areas.
get financing. I think that's really, and that is important.
Mhm.
We need rural America to be thriving.
Yeah.
So, yeah.
Any other loans that we haven't touched on that are general?
So we have land loans. So land loans are just what that speaks to, only land.
Okay.
So if you have a buyer that's wanting land to eventually build on, but they don't yet have their plans and specs and cost sheet or builder picked out,
So it can
they're
be
not ready.
a lot,
It
like
could
a
be
standard
just-
lot,
yes.
all the way up to acreage.
Yes, absolutely.
Okay.
The differences are what we refer to in the business as raw or improved.
Okay.
So raw land is not going to have utilities to the property,
Okay.
whereas improved land is.
Oh, interesting.
So-
So it's neither. So improved doesn't mean there's a house on
Nope.
it. Improved means that it's ready for it.
Utilities, yes.
It's ready to plug and play. Okay.
And most likely you are going to get better financing options on improved land
Sure.
than you would raw.
less
Of
risk.
course.
Again,
Okay.
less risk for if it comes back on the bank to sell it. Right.
Exactly.
And that's what all this is about is if
Risk
it comes
levels.
back, what is the risk level and the ability for the bank to get rid of that property and recoup their money.
Recoup their money.
Yeah.
Yeah. There's always risk involved. So then say your buyer buys the land, they have the land loan to secure that property, and 2 years down the road, they're ready to build.
Yeah.
So now they're going to go out and take out a construction loan. So it's kind of like big fish eats little fish.
Yeah.
That construction loan is going to pay off that land loan.
Okay.
Construction loans
Just kind
are,
of rolls into it.
yep. So the first draw on that construction loan is going to be to pay off that
Oh,
land
interesting.
loan.
That makes sense.
Okay.
So it's a way to hold the land
Right.
until you're ready. Then when you do it, you go to the second one, which then supersedes and takes over.
Takes over.
And then here you go. So you
Exactly.
relieve yourself of this one and you're moving on.
Now
to
you have this one. You're never going to have a land loan and a construction loan on the same property.
And for all of
Okay.
you listening, I'm putting my hand up and then I'm
We're
taking my
big
other hand
fish
and I'm
eat
biting
little
that.
fish. Yes, we are.
And a lot of the
Very
builders,
kindergarten.
people think when they build that they have to take out a construction loan, but a lot of builders will
Carry that construction
carry
loan
the
for
construction loan, and then you close like you would on an existing
Any
house,
existing
and that's
home.
when you.
them. So you're
Yeah.
buying that home from a builder just as if you were buying that home from an individual.
Mhm.
Right.
Okay.
And then that's the important thing too. Like with building loans, there's so many variations of building loans. Yeah.
Absolutely. Absolutely. A construction loan is typically a 12-month product. If your home is the luxury status, that loan can be renewed for an additional 12 months.
Mhm.
And then it has to be big fish eats little fish, rolled into your permanent financing. So rolled into that mortgage.
Yeah.
Okay.
So when it's a refinance, you're
Mhm.
refinancing that construction loan into your permanent financing.
And some builders have already started a project and you close one time at the end. And then that's how that works. So you don't ever get a loan until you close on the house. I mean, there are different ways and how, but what we're talking about mostly with this is somebody who finds a lot, finds land, buys it, holds it, and then moves on and does the
Exactly.
construction.
Now, if you have already picked out your builder, you have your plans and specs and cost sheet already done, and a property comes available,
So you don't have to do the little fish.
you don't have to do the little fish. You can take out a construction loan and secure that land.
Okay.
But you do want to have those plans.
So you just go big
and
fish, no
specs.
little fish.
No little fish at that point. And I always tell my clients, take into consideration, an appraiser can always go out to that property
Mhm.
and put a value on that property, but then they are turning to black and white. They are turning to your plans, your specs, your cost sheet to put a value on the build of your property. Make sure that those are as detailed as possible.
Yeah.
We want all the value that we can get.
Because you're
Based
going to
on-
go over. I mean,
it happens. Yeah.
Yeah.
I mean, but you
absolutely.
are like people go, oh, I can live with that. But then in the process, like, well, why not add that? You know, it's
Mhm.
even like
My
the
lighting
difference-
budget just went up.
Well, the
Mhm.
difference in $1.50
Slightly.
knob compared to a $2. Well, that sounds like nothing, but how many knobs are in the house?
Oh,
I mean,
yeah.
like those kind of things add up. So don't, sometimes people they try to play the ideal in the beginning instead of what's real, and it
Maybe
bites them.
add 10,
Yeah,
20%
honestly,
to what
and
you
be surprised at the end. Yeah.
that's gonna
Be
pan out
surprised
to
in
be.
a good way, not in a bad way.
And it's
Mhm.
great if you have a contract that you've literally lined out. Here's all the things that we're adding and subtracting from that base price, so
Mhm.
everybody's clear.
and then you
Absolutely.
stick with it. Yeah.
Yeah.
Absolutely.
So, all the time I run into people who are like, "Well, I'm self-employed. I can't get a loan."
Oh.
So, let's
Let's
talk about.
speak to self-employed.
Yeah.
So
Since
For all
we-
of us that are self-employed.
I know.
Yeah, exactly.
We have a lot of agents.
Realtors get it because we are self-employed.
We have a lot of agents that watch the podcast, so I'm speaking to all of us.
To all the agents. So there are a lot of lenders out there that are scared to death of self-employed borrowers, just because it can be such an income analysis process up front to get that borrower qualified.
Mhm.
So 2 years, you have to be self-employed for a minimum of 2 years or 24 months. You're going to be producing your personal and your business tax returns, and then most likely a year-to-date profit and loss statement. So if I
Make sure you're on track.
to make sure you are on track, exactly.
Which as a realtor, you can have your accounting department pull that pretty easily for you. I mean, like
to see where you're at.
since the majority of our people are realtors listening,
Mhm.
if you have a company like Chenoweth, you can call and they can run your year to date on what you've produced.
Mhm.
So
And so what a lender is looking at is the year over year income. So if 2 years ago you had a stellar year and last year was not so great, you have what we refer to as declining income. So now we are
sounds
looking
ominous.
we're looking heavily to those year to date numbers.
Yeah, makes sense.
Is the income now stable based on last year's
Or is
numbers?
the decline the new trend line?
Right. And so if you were declining 2 years ago, last year you have, a spec, so to speak, and then your year to date is declining yet again over your previous years,
Sure.
you truly do have declining income.
Okay.
And
which can happen pretty easily. Like if you look at COVID times when we were making so many sales, boom, 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 boom for a couple of years. And then, if we get back into a natural market where maybe that's come down a little bit, it's actually better to get real about where you're stabilizing, because you are committing to 30 years of, I make this amount of money and I can afford this. So it sounds kind of like, oh, you want to try to make it look like, but you really want to get realistic about what it is you're going to, because this is a commitment that you're going to make that monthly every year.
absolutely. So with the 2 years, you have an average. So we're pulling in a 2-year average. So if we go back to that situation where we had stellar year, we've come down a bit, and now we're stable for our year to date versus last year, then the underwriting guidelines are not going to allow for us to pull in that stellar year. Even though the guidelines speak to averaging it over 24 months.
So it's like a mean, not an average.
Yeah. So then you get to the point where, okay, as a lender, as I'm originating this loan, I'm going to originate it based on a 12-month history and prove to the underwriter that we are now stable. So an underwriter can only underwrite a loan in which they are given. They cannot go in and change things. So it is very important for the original lender, the one that's originating that loan, set it up properly.
So that's the difference between going online and throwing all your information in there and somebody just plugging it in and whatever happens,
yes,
or not, or somebody that's local that will go, oh, no, we're going to really do this in this way.
We're going to dive
That's
into this.
That's a very important point.
Absolutely.
You can go online and you can get $30 off on your monthly online, and then end up at the closing table and it's $300 more, and it makes no sense to you. Or do you end up?
Yeah.
And oftentimes you don't.
Right.
And that can come at the very end.
Absolutely.
I've had them at the very end go, oh, you know what? We don't even have that loan anymore, and we're not doing that. I mean, it literally
Crazy
can
town.
happen. Yeah.
Well, and so but
I've had other transactions that were really good online. I'm not saying it's all bad, but boy.
But it's square peg. If you're a square peg, that's great. Because if you're round and coming through that conveyor belt, you're not fitting in anywhere, and you're just going to get pushed to the side.
And whenever they realize you're not going to work,
they get rid of you.
You cannot get a hold of anybody.
Crickets.
It's not like you can work through and maybe find another option. They're just gone.
Yeah.
And you have to start all over with somebody else.
At least if it's somebody local, you have friends in common. Maybe you're in the PTA together. You're going to run into them at church.
Your reputation works.
Yeah.
Your reputation
you
matters.
Or they can get their hands around the neck.
That's what Cheryl Chenoweth says.
Yeah.
But I don't want to discourage self-employed borrowers from purchasing property.
Yeah.
What's
such a large part of the population.
Absolutely. And so I will dive in to those finances and do all those underwriting guidelines applied to their income, so they have a very clear picture. I am not going to give them a pre-approval and not do the income analysis and wait till we get into underwriting for the underwriter to apply those guidelines and say, you have declining income.
I also think it's really important that if you are self-employed, you really want to undershoot your payment, and you want to have a realistic idea of what your monthly, on top of your loan payment, but your insurance and your interest, like that's going to keep increasing. You really need to know that, because that's the one thing you just don't want to put yourself in a position where you're house poor. You don't. I think it's easy for us as realtors to say,
buy that more
expensive house. Yeah. But we really have to think monthly. We really all do. And it's like, if you're going to have to rent something if you don't buy, right? So if you don't buy, you're going to have to rent. So you're going to have to meet a monthly payment. So being comfortable with that is
Key.
really key. And so
And the two variables in that are going, if you're on a 30-year fixed or a 15-year fixed, the only variables you have within that payment are your taxes and your insurance. And something to consider when you're purchasing a property, the taxes that the seller has for the previous year most likely won't be the taxes where you will have, because maybe they've been in the property for 10 years. They filed homestead on that property. And so they are capped. The
Right.
county assessor can only increase the value of that property 3% year over year, and therefore raise their taxes accordingly. If you come in and buy this home for $400,000 and the county assessor has that property maxed out for the current seller at $270,000, their taxes are much lower than what your taxes will be.
It's going to go up.
It will be. But here's the caveat. Regulations will not allow me to charge you for your taxes based on where they're going for market value.
Wow.
Oh,
I have to use
Current.
last year's current
So
data.
it's going to go up.
It's going to go up.
Unless you bought something undervalued.
And so we always want to make sure that we're educating our buyers that, yes, you have escrow in here of, say, $300 a month for taxes. However, next year, that is likely to go up to $375.
Yeah.
Just so we know.
Boy, in new builds,
where-
that's a really big thing on new builds because it really goes up like
So-
from nothing to a lot.
So nothing to a lot. That one's a little different because since
You
that
can
property
charge.
is now is an improvement on it.
You can set it based on the current
we
rate.
can set it based on we'll
But when
rely
you're
on the
putting an
title
offer
company.
in,
If you're talking existing home
yeah.
that somebody else has lived in,
Mhm.
that's what we're referring to. New construction, we will pull the tax mill rate for that property based on what it's being sold for.
Yeah. And
And
factor
impute
that
those
in.
and impute those taxes into your escrow.
Yeah, and factor that in because I think a lot of times they look at and people don't think about that. They just look at the payment of the principal and interest, and new construction taxes are high. They are. And you're paying for that privilege.
So I've got a formula. So we don't know where our buyers are going to go buy their home. So a good formula for estimating taxes is 1.3%
What about insurance?
of your purchase price. 1%.
So 2.3 should give you your taxes and insurance.
It will. I break them down. I do 1.3%, divide that over a 12-month period, and then 1% divide that over a 12-month period, and those are your escrows, taxes, and insurance.
Interesting.
It'll get you
That's great.
It'll get you pretty close.
I like that. I've never
Yeah.
heard of that formula before.
I've got it on sheets. You can reach out to me if you're an
I
agent.
know she brought
And I
us
can send you.
all these little goodies, and I can't
Mhm.
wait to look through
Tons
them.
of goodies.
Calculating costs.
One
I mean,
quick
everything.
wrap-up question.
Okay.
In your opinion, in 2008, when we were kind of in a lull season, like we've been a little bit in a lull season, there were so many foreclosures. That is not the problem we're having now.
We are not seeing that. We had many, many, many more properties on the market at that time. We're not.
We're
if
not
you're-
in a
If you're
distressed
an investor,
market.
we are not in a distressed market, and the investors out there will tell you there are no foreclosures to be
Yeah.
had.
Yeah.
Because a lot of them like to step in and try and get a deal on those properties. We're in a completely different market. The government stepped in and regulated
Mhm.
the mortgage industry so heavily after the crash in 2008 to really protect those borrowers and those buyers against those predatory loans that resulted in all of those foreclosures.
And we have people at low interest rates, high or low unemployment. So we have sort of the opposite in those macroeconomics going on. So I think that there's still this view for the public that times are bad, and that means there's going to be all these foreclosures, which at first I thought there might be some of that, and it has not panned out to be the case. And now I think we're past where that's going to probably be the case. But so with that being said, that also is still putting pressure, like you said, Cindy, that's putting pressure on our inventory rising to meet the demand when the interest rates come down. So all of this together says we're starting to get in the zone. I have not been a person who has push, go by no matter what the rates are. I have not done that. I think we're in the place now where rates are getting where it's competitive, and you have to really look at the opportunity cost of not jumping in if you're ready to jump in, because right now you really can buy down your interest rate a little bit, ask the
Absolutely.
seller to, or you can refinance at some point.
Absolutely.
So I think that's really important that we look at that in that light right now, that we are at that precipice now, possibly, where this is the time to start thinking about coming back into the market if you've been responsibly holding.
Right.
Well, and I think Dave Ramsey is a recognized financial analyst out there that is very conservative. And there is
Very conservative.
very, very conservative. And he put out a video almost 2 years ago that I just absolutely love.
Yeah.
He was interviewed about home ownership and buying homes in a high interest rate market, and he's hands down buy the home.
Now.
But what about this? Buy the home.
Yeah.
Every question that he was given, he said, buy the home. He said, historically, homes have only come down in price one time in 100 years.
Wow.
In 100 years. And it was, what about if rates are at 10%? Buy the home. You can refinance.
What is that? When is the best time to buy a house?
Yesterday.
I it's funny. I've been in this so long, and now I think, oh my God,
It's
if
true.
I had just stretched myself a little bit when I was younger on some of this stuff, like I would have. I mean, you could have done, but you can't go back and be something different than you were. So that's great. Now, the one thing I will say, what do you think about the whole Dave Ramsey thing? It's great, except then he gets into all cash, and then people go to get their financing, and they don't have credit. You have to be careful with some of that. Like, I understand what he's trying to do, and if you are somebody who has a problem with spending, having credit cards is probably a problem. But for those of you that are young and you're starting out, you have to balance and learn to use credit in order to build credit and have credit when you want to go buy a house. I think this whole, the young people that are young people, I sound like I'm 1,000, but the young people that keep saying that they can no longer afford a house, I understand where you're coming from. I totally do. But there are certain things you have to do. One of them is you must establish credit. If you're a woman who is married and doesn't work, have your own credit.
Absolutely.
In case you need it, and you will need it at some point.
Even if it's getting a secured bank card from your bank or a gas card, anything, just start
a small loan
building
on an appliance
building some credit, and
make sure they report to the credit bureau.
Let's talk real quick about credit, and then I'll let you go. But for being responsible with credit card debt, we only want to use 30% of the overall limit that we have on that credit card.
Yeah.
Okay. Once you go over 30%, it can start hindering your credit because it looks like you're living beyond your means.
Which you are.
Okay. So keep it below. If you've got $1,000 limit on a credit card, don't go over 300.
Yeah.
And if that minimum payment is $25 a month, pay 30. Pay 35. But even if you just pay 30 and on time, I cannot stress enough.
Auto draft.
And then another trick that you can do is you can make a double payment. You can make the payment on the 1st when it's due, and you can make another payment on the 15th.
And you can do that with your mortgage too.
You can do that with your mortgage too. This will require the credit bureaus to report another payment, and it's going to be an on-time payment. Okay. So just little tricks there for so many that are like, no, I don't want a credit card. We want you to be responsible with them, but it can absolutely help you build your credit. It takes 1 month to tank your credit.
Yeah.
1 month.
For a long time.
For a very long time. It'll take you 12 months to build that credit back up.
Yeah. And then the other thing I always tell people, auto pay a little bit over your minimum, and then you can go on the app or you can go on the computer and you can make a bigger payment when you want to, but always make sure that at least you're doing that.
Absolutely.
And then anything else you can do, I mean, I pay mine off every month. I mean, it's like, and that's why my credit has gotten so good, because it's like I use them, and then you get all kinds of benefits from that too. But I always pay them off. I always have the ability. But let me say, I also don't take out a 15-year mortgage because I'm self-employed. I take out a 30, because if I can double pay, I can pay more. But I want the flexibility of the lower payment in case I need it. I also pay my credit cards off, but I keep credit in case I ever needed it, because like you said, things happen in life, and there are times when you're going to need credit and you're going to need a little bit of flexibility.
Yep.
So, always trying to be so responsible that you set yourself up for failure was a lot of the problem I think I had in the past, when I would be doing well, I would overdo things, and then I wasn't prepared whenever something did go wrong
Right.
or fail to come in.
Right.
So I think it's always that finding that balance for people between, especially younger people, not even younger people, all people.
All people.
Yeah.
Yeah.
It's finding
Being
that balance.
financially
If you are
responsible.
somebody who has a lot of money in the bank and you're just doing this, a 15-year note makes a lot of sense. You can get it paid off quicker.
Well, here, I will argue that if you look at the interest rate difference between a 15-year note and a 30-year note,
Okay.
chances are it's not half. Okay, so chances are
Interesting.
it's not going to be 6% on a 30 versus 30 or 3% on a 15.
Okay.
It will likely be 4.5 or whatnot. I will not put a client in a 15-year
Because they can
note.
pay it off in 15 years.
They can
for
pay it
less.
off in 15. And here's the thing, it's called your effective interest rate. What is your effective interest rate based on what you're paying against? So for this easy math, I've got a 30-year note at 6%.
Wait, there's easy math. I'm sorry. Go
Yes. Okay. Follow me.
ahead.
30-year note at 6%. If I pay that off in 15 years,
Mhm.
I've cut that interest rate in half. My effective interest rate on that loan is now 3%.
Oh.
Why would I have put myself in a 15-year note at 4.5% when I could put myself in a 30, auto pay out what it would cost me to pay off my loan in 15 years,
Mhm.
and my effective interest rate is 3%.
Okay, so now I'm taking my two hands by my head and going like expanding, because that just blew my mind. I have never thought about that, Nikki, and that makes so much sense.
So much sense.
I mean,
So
that makes
I
so
always
much
say
sense. I
I'm
love
not an
that.
order taker. I'm not an order taker. You don't live in my world. So anybody that even comes into me and says, I want a 15-year note, and I'll go, let's analyze that.
Yeah.
Let's have a talk. Let's discuss this. Let me lay out everything for you. And if you still feel that that 15-year note is in your best interest,
You're the client.
financially, then so
Wow.
be it.
So
But
you're,
nonetheless, I'm going to show you all options.
so you're
Right.
giving yourself the flexibility and freedom of a lower payment if you need it. When you
Absolutely.
need it, you're giving yourself, and like we said, you could do the 2 payments a month. So you could do 2 full payments a month and get it paid off in
half the
15
time.
years and at the lower interest rate. But then you could always cancel one payment and keep that money for
If need be. It's Christmas.
Wow.
Let's spend that money on
Excellent.
Christmas.
I think that's
Okay.
probably the thing that I will take away from this the most. That's
And there's
awesome.
an effective interest rate calculator out there.
Yeah.
Call me.
Yeah,
And
I
that's
can
in
run it
fact,
for you.
why don't you give folks your phone number and
Yeah, you
your
bet.
email?
So Nikki Pauly, if anybody wants to make application with me, NikkiPauly.com takes them straight to
Spell that for people.
NIKKI PAULY.
That is NIKKI.
Paul with a Y. So that takes them straight to the secure mortgage application where they can start that application.
Okay.
I have had the same phone number for probably 30 years, 918-697-6226. Cell phone, call or text. And then Nikki@hometeamlens.com is my
Awesome.
cell.
And Home Team is a mortgage broker,
Mortgage
not
broker,
a bank.
not
so
a
you
bank.
have a lot more flexibility.
We can shop. So we like to say that making application with your home team lender
Mhm.
is just like making application with 5 other local lenders, because I only pull your credit once and then I get to shop on the open market for you.
Okay.
Who is the best investor for your specific situation?
Interesting.
Mhm.
All right. Well, Nikki, thank you
Awesome. Thank
so
you.
much
This
for
was
coming
awesome.
in.
Yeah.
Thank you for having me.
You know, I
Great
just love these
information.
too, because it's like you do this for all this time, and I've just been in the mindset of the 15-year, and that was that's so great to keep learning
Mhm.
and to rethink those things.
And that's why
Absolutely.
it's important, I think, to bring in a professional. If you're
Yeah.
selling your house, have somebody by your side who does this day in and day out. If you're, getting a loan, make sure you go to a person you can actually see and talk with in person and strategize together.
Absolutely.
But like to that example, 1.5% a year
Right.
of
A
savings.
big difference.
That's a huge difference. Yeah.
huge difference.
Wow. Thank you.
All right. All right. Well, thank you guys. We will be back next week. Don't know what we're going to talk about, but I know it'll be interesting.
Good to see you guys. Thank you so much.